More recently, in the American Omaha state, Nebraska held an annual meeting with Berkshire Hathaway shareholders, also called Woodstock for the capitalists. It attracts thousands of investors every year who want to hear the opinion of the head of the holding, Warren Buffett, and his partner, the vice chairman of the board of directors, Charlie Munger. For 7.5 hours, they discussed everything from the state of the economy, shares, banks, and printing new money before investment in China's artificial intelligence and Apple. I chose the most exciting moments of the performances. We will analyze them in detail with you. So let's start with the action. First, why is Buffett buying up Apple? Then, discuss how Warren Buffett comments on concerns about what's on Apple stock now accounts for 35% of the company's stock portfolio. Buffett said, "Apple is not a 35% portfolio of Berkshire shares. This portfolio includes railroad shares, energy companies PacifiCorp, and Northern Power Grid, all companies. Still, our criteria for Apple differ from those applied to other companies' shares we own. Just Apple is the best business in our portfolio, and we invest a lot of money. But we have invested in it no more than railroads. Railroads are too good business, but not nearly as good as Apple. This is a massive portfolio of stocks of other companies, among which Apple occupies the key place. Let me remind you that Berkshire was founded in 1965 as a manufacturer of textiles. She later began buying other companies as her assets. Berkshire's stock portfolio is a vast collection of other companies, which she does not wholly own but only partially. Of course, if she buys such companies, then they are in it will dissolve. Thus, Apple's share does not account for 35% of the stock portfolio. Berkshire, much less. I consider the insurance business, railway, energy companies, etc. But there is one thing worth discussing. Think about it, and Charlie talks about it in the following snippet. If you will be looking at it just like a briefcase share, then is it a problem to share Apple accounts for 30, 40 or 50%? One of the stupid things they teach. You don't need to buy many shares. In modern universities, extensive diversification is necessary when investing in shares. This is a crazy idea. The point is not to have many good opportunities that are easy to reveal. And if you only have 3 options, it is more likely a good arrangement rather than a bad one. If you know the limits of your possibilities well, you should ignore most. Expert advice on portfolio diversification, which I call portfolio deterioration. Charlie has always held this view. There is logic here. He needs to contact you to stop diversifying. But if you have one investment option that is better than others, then you, of course, should invest in it more than other options. Imagine that there are 2 companies whose shares are equally cheap. If one grows noticeably faster than the other, with ample liquidity and significant competitive advantage, will you invest your money in these 2 companies equally? Probably not. So we discussed Apple. Now, how Warren Buffett explains one of the weirdest things ever. Berkshire for a long time. Large share purchase, Taiwan Semiconductor, which followed their surprise sale. Buffett said, "Semiconductor, one of the best managed and most influential companies in the world. And you can say the same most in 5, 10 or 20 years. I don't. I like its location, and in this respect, I changed my mind. Furthermore, I feel safer about the capital we have placed in Japan than in Taiwan. Of course, I wish it weren't, but that's the reality. Therefore, I reconsidered my attitude toward this event." So this confirms that strained relationships between China and Taiwan drove Buffett's share sale in Taiwan Semiconductor. We about it guessed. Given that Taiwan Semiconductor is a very reliable company, Buffett would not be like this to quickly sell this prominent position. Still, it's great that we heard it from Buffett himself. By the way, Warren and Charlie had another mention of China. Let's listen. Buffett said there is an inevitable economic tension between the US and China. Both sides are to blame, each of them acting equally. Charlie Munger has always believed that the United States and China are much more profitable to be friends than enemies, and such a point of view is quite logical. But as Warren explains, it usually interferes with personal interests, and there is one big problem. There are 2 superpowers in the world, and they know that they need to be friends. Each of them can destroy the other. They will compete with each other. This is a game. That was a brief overview. Comment if interested, and remember to subscribe to our channel. Here you will find the latest information from the world of economics, a lot of exciting news, and much more. With you, Market Watchtower News. See you soon.